from the LTC collaboration, and thank you for joining us today. The LTC collaboration is conducting a series of interviews with industry experts regarding the pricing of long-term care products being sold in the market today. Prior to starting our interview, I'd like to briefly describe the new LTC collaboration service if you're not familiar with it. The LTC collaboration is a portal dedicated to agents and brokers across the country who find it difficult to keep up with all of the different types of LTC products available in the market today. It's a place where you can see the unbiased reviews of LTC products from other brokers. Think of it as the Yelp for LTC products. Right now, we have to rely on the biased marketing materials from the carriers, which always places their product in the best light. The reviews on the LTC collaboration, however, are the unbiased opinions of independent brokers just like you. The only obligation to joining this new service is to do a product review yourself. Please go to the website at ltccollaboration.com that you see on your screen, where you can watch a demo of the service and join. Today, my interview is with Jim Glickman, who is the president and CEO of Life Care Assurance Company. We're going to be discussing the National Association of Insurance Commissioners Model Rate Stability Regulation, or LTC. Jim, how are you today?
Doing very good. Thank you, Tim.
Can you give us a little bit of background on yourself for those of our viewers who aren't familiar with you?
Sure. I'm an actuary by background, and in 1982, I first started working in the long-term care pricing area for a company at that time called Pencor. In 1988, I, with some other people from Pencor, founded a company called Life Care Assurance Company. And we decided to specialize in long-term care and help the very large insurance companies get into the long-term care market. That's what we've been doing now for the last 32 years. I also have been very involved in the long-term care industry from the standpoint of developing the long-term care section of the Society of Actuaries, and then developing the LTCi, which is the Intercompany Long-Term Care Conference Association. It runs an annual long-term care meeting for approximately 1,100 attendees every year, of whom about 350 to 400 are producers who come to the conference under what we call producer scholarships and get an immersion into long-term care at a very reduced rate for that conference. In 2005, I joined the Society of Actuaries Board of Directors and served on there for 5 years. And in 2017, I was elected to the post of president-elect of the Society of Actuaries. And in 2018, I actually started my year as president, and that year as president will end in November, when I become the immediate past president of the Society for 1 more year before my service to the Society is complete.
Great, Jim. Thank you for that. Obviously, some very extensive background in the LTC industry. And if you don't mind, you might want to sit a little closer to your microphone so we make sure we can hear you okay. That would be great. So let's begin with the interview.
Sure.
My first question for you is, can you describe at a high level some of the major changes required by the rate stabilization regulation?
Okay, so from an actuarial standpoint and a regulatory standpoint, long-term care historically fell under what was called the minimum loss ratio regulations of the NAIC. Those minimum loss ratios required that a carrier prove that they were providing at least, and depends on state, 60 to 65% of their premiums in benefits to the insured. Since the regulators were concerned that the benefits be high enough relative to the premiums, this was implicitly a factor that tended to push premium rates down to lower and lower levels. So in the 80s and 90s, regulators would actually turn down premium requests that now have proven that they would have been sufficient and required carriers to offer lower premiums back then because they felt that the likelihood of them not achieving those minimum benefit levels would otherwise be in jeopardy.
Wow.
So in the late 1990s, it started to become apparent to the regulators as well as the industry that there was a much higher risk of future rate increases under this minimum loss ratio regulation. So both parties got together and said, how can we fix this problem? It happened with the substandard companies doing very major rate increases, companies like Penn Treaty and American Travelers. And it even entered into many of the mainstream carriers who, of course, had to compete against those companies and were very premium sensitive. So the regulators came up with an idea that the industry supported of a rate stabilization way of looking at products.
Okay.
Now, what that did is it said, we want you as regulators and you as carriers to price your products to minimize and hopefully eliminate the chance of future rate increases on products that you issue on a forward-going basis. That means we want your premiums to be as high as you feel they need to be sure that even if experience is moderately adverse, you still will not have to raise premiums. So when this law was passed, all of the companies went back and looked at all their assumptions, made them quite a bit more conservative, and the average premium of long-term care policies went up across the industry about 40% on new business.
Wow.
These were not rate increases per se, and these occurred in early 2000, but the average premium that was being sold of about $3,000 per policy went up to the equivalent of what would have been about $4,200 per policy.
Wow.
And at that time, many of the companies decided that that was a bit rich for most people to afford. So that was when the insurance companies initially started suggesting that 3 to 5 year benefit periods were long enough instead of lifetime benefits. Because as you can imagine, lifetime benefits are about that same 40% more expensive than a 5-year benefit period. And that way, everybody can continue to sell the $3,000 average premium. They just get a 5-year benefit period now instead of a lifetime benefit period.
Right.
Now, the big change that occurred in companies' assumptions, and correctly so, under rate stabilization policies, is that the lapse rate, which is the rate at which people voluntarily choose not to renew their policies, was greatly reduced. Long-term care is what's called a lapse-supported product. And as such, what happens is when somebody stops paying premiums, all of the pre-funding that's in a long-term care policy then releases back to the company.
Right.
And the company assumes that amount that's released back to them can be used in the initial pricing to reduce the initial rates. So back in the 80s and 90s, when companies were using 5% ultimate lapse rates, the premiums were about half the size of what they would have been if the companies were assuming only 1% lapse rates, which is much closer to what the real lapse rates have turned out to be.
Sure.
In addition, because companies in the 80s and 90s were not collecting these twice as high premiums as what they should have been pricing for, what occurred is that essentially they not only lost out on those premiums, but people who stayed on the policies weren't being properly funded with interest or survivorship. So when companies finally got around to, in the 2007 to 10 era to starting to do rate increases on the pre-rate stabilized minimum loss ratio policies, they were actually having to increase them by 40, 50, 60, even 100%.
Right.
And that's the rate increases that you've seen almost uniformly across the industry. Now, policies that were priced in 2005 and later, after rate stabilization went into effect, most of those are pretty stable. And while there may be some rate increases on some of those, they tend to be much more moderate when in fact they even occur. And the reason that there are still some rate increases going on the newer policies is because, as you can imagine, not only have lapse rates turned out to be not 5%, but they're not even 1%.
Sure.
Lapse rates currently are running about 1/2 of 1% for the industry. So
Wow.
you can attribute probably about a 10% underfunding of even the newer policies to that attribute. Also, another important factor is interest rates, and that has also been declining. And in recent days, or actually last few weeks, it's gone down even more. Now, we do expect that sometime in the future, those interest rates will go back up again. However, the short-term effect is a negative one on the pricing.
Sure.
If somebody has bought a policy, and we'll call it in the 2012 to 2020 era, I think they can pretty well feel comfortable that there's very little chance that they will need rate increases. And that's because the lapse rates are already at rock bottom levels of about 0.5%. The interest rates were assumed never to be in excess of about 3 to 4%.
Okay.
The mortality was assumed to be improving, and the morbidity has actually performed better than what people expected. Morbidity is actually the rate at which people make their claims against their policies.
Okay.
So if I were out there selling as a salesperson, I would feel very comfortable right now buying a policy that's being offered in the long-term care industry and not having to worry about future rate increases. In fact, there's at least one company that I know of, there may be others, that now offer both single pay and 10 pay, which essentially have rates that can't be increased.
Right.
And that's only because the companies can feel comfortable in the new pricing that's going on now under rate stabilization.
Great, Jim. Thank you for that explanation. My next question is, overall, how has the regulation impacted the initial pricing of new LTC products coming into the market today?
Well, as I mentioned, when it first went into effect in the mid-2000s, it raised rates across the board about 40% from what they had been just immediately prior. Since then, lapse rates have continued in a bit of a downward motion, and as I mentioned, interest rates have likewise. So for most companies, their new pricing has gone up another 20 or 30% over the following decade, from about 2005 to 2015, to where they are in present day. There's been very little change in the pricing of standalone long-term care, I would say, since about the 2015 era.
Sure, but that has to do not necessarily with the regulation itself, but the new information we have about lapse rates and interest rates, et cetera. Is there anything that has changed the initial pricing directly from the regulation itself?
Well, the only things that have changed it from the regulation itself is the fact that companies are required now to price with their best estimate assumptions plus a pad for adverse experience. And in fact, the pad that they're required used to be around 5%, and now it's a minimum of 10% as the regulators have defined it. But in addition, as interest rates have trended down and as lapse rates have proven to be a little bit lower than they expected, they keep updating those and then adding a pad on top of that. So the reality is there's been no real effect on policies that have been sold since 2005 overall.
Okay.
But the pads that were in the 2005 policies have mostly been eroded. So if assumptions get worse on a forward-going basis, they could very well need some rate increases. The newer policies have the most current assumptions and have pads on top of that. So there's really very little chance that they'll go up from here. In addition, one of the things that the regulation did when it was put into effect is it said that if you ever do need a rate increase on a rate stabilized product, not only do you have to get on a forward-going basis, an 85% loss ratio on any new premiums you ask for as a rate increase, but you have to retroactively have achieved a 60% loss ratio on your initial premiums. So there's a very significant penalty to companies to not price adequately under rate stabilization, even under the worst of circumstances.
So what you're saying, just so I can say this back to you again, going first back to what you called the pad. So an actuary prices the product, and then they say, I'm going to arbitrarily add another 10% on top to the premium just to make sure I don't have to have a rate increase. Is that what you're saying?
That's exactly what's required under the law, and the actuaries actually have to certify to the regulators that they can withstand adverse experience without needing a rate increase as well.
Okay, great. And then back to the second part of your comments, which is in regards to if a company has to file for a rate increase on an in-force block of business, can you explain one more time to us the change in the loss ratios that they have to meet and what that means?
Okay, so first, let's go back and look at where 90% of the rate increases are occurring, and that's on the business that's under the old loss ratio standard pre-rate stabilization. On those, the company just has to certify that their past experience plus their future premiums under the rate increase will meet that minimum of 60 to 65% loss ratios.
Okay.
And they can then raise it to whatever level they need to in order to make sure they achieve that 60 to 65% loss ratio. On rate stabilized policies, what they're required to do is they're required to certify that they will have achieved a 60% loss ratio retroactively on the initial premiums they did, and that they'll achieve an 85% loss ratio on any of the rate increase premiums that they put into effect for the future. So they have to meet a much higher standard and thus a lower increase in premiums than they could have under the pre-rate stabilized policies. And for that reason, they're very reluctant to not make sure their policies under the rate stabilized pricing are adequate, because it's very likely they'll be able to make money on that block if they have to do retroactive rate increases.
I see. So just for the layman out there, a loss ratio is the amount of money they have to pay in claims in comparison to what they're bringing in premiums.
That is correct.
Okay, great. So next question, Jim, is does the regulation impact at all the pricing of LTC riders on life insurance and annuity products?
Actually, life insurance hybrids that have long-term care elements to them are not subject to either the minimum loss ratios or the rate stabilization provisions. They are viewed strictly as a life insurance policy for which there are no particular regulations on them. And for the most part, the long-term care portion of the benefit is a very minor piece of the total cost. And as such, it is typically guaranteed by the carrier from day one anyhow. So you have neither rate increase potential, nor do you have any situation where they would have to give back any excess profits if they were to have them.
Okay.
You can also view it from the standpoint that they do declare on some of the types of policies, depending on what the long-term care benefits are attached to, the earnings rate that they're going to attribute to the policy, and that they get to adjust. However, they're subject to minimum standards. So, for example, most life policies have a minimum 3% interest rate guarantee that has to be applied.
Okay. All right. Thank you for that. So, is there any evidence overall that the regulation has reduced the number and amount of rate increases requested by carriers since it went into effect?
Well, again, you have to remember that anything that was originally issued under minimum loss ratios is, for the next 60 years, subject to that regulation. Any policies that were issued under rate stabilization are subject to the new rules.
Right.
So you can look across the whole industry and you will find almost no rate increases on the policies that were filed under rate stabilization. And you will find for the policies that were issued pre-rate stabilization, almost every one of them has rate increases.
I see. Okay. So finally, Jim, for brokers selling LTC products today, what can you tell them that would give them some confidence that the products are appropriately priced?
Well, probably the best thing I can say in that regard is the fact that carriers would not consider offering products that were essentially non-can, where the premiums are guaranteed in place, if they had any concern currently that there would be an issue with future rate increases being needed. And in fact, the new carriers who have come in since then have tended to offer some of those types of benefits. And if the agent's client is concerned about that, they would find that they can actually buy a lot more long-term care coverage in a single premium setting on a standalone long-term care product than they can get under a hybrid in terms of the long-term care benefits.
Sure.
In fact, one of the companies I know of that offers the single premium also offers a return of premium on death, where it can operate almost like its own version of a hybrid. And you'll again find more long-term care benefits per dollar of single premium you have to spend, with all the same guarantees you'd have under the life policy. One of the other things that's important to bear in mind, whether you buy a hybrid or whether you buy a standalone, is you always want to buy the inflation protection and make sure that the inflation protection is in place starting on your first dollar of benefits. So for example, on some hybrids, they pay at the original daily benefit until you use up all your death benefit, and then they inflate the extension. You want to buy, even with those companies, the version of their policies that actually inflate every dollar from day one.
Sure.
If you're buying long-term care, you're meeting the underwriting standards. And if you're meeting the underwriting standards, you're unlikely to have a claim for 30 or 40 years. People have trouble relating to the fact that even modest inflation, compounding over 30 to 40 years, would make you drastically underinsured, even if you were buying double what you need today in terms of the daily benefit. So you're much better off buying a smaller daily benefit today and putting the inflation protection on, whether it's a standalone or whether it's a hybrid, and then going from there in terms of your long-term care planning.
Great, Jim. Well, that concludes our interview for today, and thank you very much for joining us. We appreciate all of your expertise and your time today. And for those of our viewers, please stay tuned for more interviews from the LTC collaboration posted on the website and on social media. Thank you for joining me today, Jim.
My pleasure. I enjoyed it.
Have a great day.